Hi and welcome. I'm Rich Harvey, CEO of Propertybuyer, and today we've got a fantastic webinar lined up for you on Sydney suburbs set to shine and getting real market insights. And with me today is Louis Christopher. Welcome, Louis.
Good to be here.
Louis is the Managing Director of SQM Research. They provide some fantastic data on a whole range of data points across the property market and provide some great property ratings for all of their clients. So Louis, today we're going to talk about what's actually happening in today's property market. And there's been a lot of changes. We're seeing a bit of a rebound happening, but I'd like to really cover off particularly around the major prime markets in Sydney. So the Eastern Suburbs, the Inner West, the Northern Beaches and the North Shore, and particularly drill down into some of the detail, which I know your data can really pinpoint what's happening. So, but before we start, what are you seeing as the status of the market? How do you describe the Sydney property market right now?
Well, the Sydney housing market has definitely changed from where we were prior to the election. On our numbers, it appears as though the very week of the election was a bottom in the marketplace. And since then, buyer demand certainly picked up. Seems to be fairly much across the city, perhaps some regions stronger than others. Auction clearance rates, as you know, have also picked up. Asking prices of vendors have also been lifting their asking prices as well, perhaps a little bit too aggressively so in some areas. But overall, the sentiment's completely changed. So in our view, prices are rising as we speak for most regions in Sydney.
It's interesting you say the election was really marked the bottom of the market. I mean, we noticed that in our business in terms of the level of inquiry. The beginning of the year was completely flat because we've had a state election and a federal election. And buyers were just sitting on their hands, not making decisions. Vendors were too scared to sell.
Yes.
So there just wasn't a lot transacting unless people really needed to sell.
Well, there was a lot of uncertainty at the time. The general expectation, of course, was that the Federal Labor Party was going to win the election, and that was going to mean for the housing market, big changes with negative gearing and rises in capital gains tax. So people, both buyers and sellers, were seriously contemplating that and what that would actually mean. And that created a lot of uncertainty. And so both buyers and sellers were sitting on their hands.
Do you think that now the elections are out of the way and the coalition's return and negative gearing's off the table, as in a change to negative gearing's off the table,
yes,
that people are more certain now, or do you think there's still some level of uncertainty?
They are more certain in our view. Now, you'll always have a degree of uncertainty. Can prices go up further from here? We have taken the view that, look, the market, while it's had a 2-year correction, in Sydney, it's still a little bit overvalued. So we are lifting from an overvalued point. And that does have ramifications in terms of the length of this new recovery and the vigor of it. So far, I think it is a strong recovery to date. But the question still remains, how long is this actually going to go for? And will we see, for example, regulators jumping in again? And we think we will see this, where they'll come in again to put the brakes on the market.
Okay, that's interesting. So, yeah, well, look, we didn't do our first initial place slide, but here we go. There's our introduction again. There's our mugshots. But look, let's drill more into the market update now, Louis. And I think we're going to just talk about the volume of listings that is occurring in the market.
Yes.
Because I think it's quite interesting. We've seen certainly confidence return to the property market.
Yes. But
we've noticed there's been an absolute dire straits lack of listings, particularly during the winter period. Really been a winter drought of listings.
Yes.
And, you know, the numbers are down. But what are the numbers actually telling us here, Louis, in terms of the volume of listings?
Yeah, so this is the full chart of Sydney listings split by days on market. And we can see the light blue bars represent a stock which is under 30 days. And on the other side of the coin, the red represents stock which has still been on the market for over 180 days. And as you can see, in the most recent years from 2018, there was quite the surge in properties that had been listed for over 180 days, as well as 90 to 180 days. This is old stock that wasn't selling because not as many buyers were in the marketplace. And it also represented sellers who weren't exactly willing to meet the marketplace. And so stock builds up. And we generally do find this in all downturns where listings actually rise, even though many agents will say, well, we're really striking out and getting new listings, and that may well be true, and it shows up in this data. The fact is that you've got a whole bunch of old stock that just simply is sitting there, not moving. And hence why you see listings actually build up during downturns. But as you can see, in more recent months, listings have been falling. And they've been falling on all counts. The stock over 180 days has been falling. The stock 90 to 180 days has also been falling. And we think this is as a result of basically more buyers entering into the market and absorbing that old stock. And also a combination to sellers finally meeting the marketplace, willing to sell after the election. Now, of course, the complaint has been of late that new listings, that there hasn't been that many new listings, and this is true. You can see in our data there, particularly towards the later end of 2018 during the spring selling season, that new listings really did dry up. They picked up a little bit in the new year, but definitely lower than levels recorded during a normal market. If you consider a normal market back to, say, 2012, 2013, listings were high. New listings were higher than what we have now, quite clearly.
Okay. Well, let's drill down into some of the other broader regions in the prime market. So let's have a look here, Louis, at the Eastern Suburbs. Always a sought-after market, very tightly held in a lot of pockets.
That's correct.
What's happening in terms of listing volumes there?
So once again, we can see that the downturn did have an effect on the Eastern Suburbs, perhaps not as much as in previous years. There was a rise in listings. You can see too that in recent months, there's been some months where there's just been a dearth of new listings come through. The most recent month that we've got, which is the month of August, there was a pickup in new listings. So we think there are some new sellers now coming into the Eastern Suburbs with the fact that there's now more buyers out there. So overall, it is a market where listings have been falling because of older listings now being absorbed. And this is also a market too that when we look at other statistics, the price falls were not as great on the Eastern Suburbs as perhaps in some of the other regions around Sydney. So overall, during the downturn, our view is the Eastern Suburbs actually outperformed the Greater Sydney market.
And why do you think it's more resilient? Why does price levels not drop as much?
It's a good question. I think in this instance, if we consider that the Eastern Suburbs is a market which, of course, contains a lot of affluent real estate at the very top end. This was a market which selling prices over $6 million really was not affected that much by the downturn. And let's think about too where investors generally operate. And because that was a part of that segment of the market that was hit the hardest. Property investors left the market in a big way during the downturn. They generally do not operate at the top end of the market. They generally like to operate in the middle to lower end of the marketplace, an area where they can afford the most.
That's it. Well, let's have a look, Louis, at the next region. So the Inner West, the trendy Inner West, what's happening with volumes of listings there?
Yeah, so once again, we're seeing listings now fall after the rises from 2017 to 2018. And what is interesting here too is that the new listings is not really rising that much. There's been a fall in new listings compared to, say, 2016 and 2017. The Inner West has actually been an area when you look at asking prices and actual prices, there were some big falls in the Inner West. That said, in the lead up to the downturn, this market became rather frothy in our view. There was a big surge in prices in 2015, 2016 and 2017, far more than the Sydney-wide average. So the correction that came was a larger correction because we thought this market was in particular overvalued. Now what we're actually seeing is a big rise in auction clearance rates in the Inner West. And we're also noticing that asking prices are starting to rise in this area, perhaps a little bit more than the citywide average. So the boom from 2013 to 2017 in the Inner West was bigger than the other regions. The falls were also bigger. And so it's a market that's just seems to have overreacted on the going down and going up.
It's at a high climb and a quick rate.
And it could actually once again overreact going back up.
Interesting. Okay. And then let's have a look at the lovely Northern Beaches. What's happening there?
Yeah, really interesting, the Northern Beaches. The Northern Beaches historically has been similar to what the Inner West has done recently. It tends to be like when the market's running hot, it's running really hot in the Northern Beaches. And when it runs south, it runs pretty hard south for the Northern Beaches. This time around with this downturn, it wasn't as bad.
It's been more resilient, hasn't it?
It's been a little bit more resilient. There were price falls, but it was definitely below the Sydney-wide average. And when we actually look at the listings here on this chart, you can see, certainly compared to, say, 2011, the surge in listings during the downturn wasn't as great.
And look back here at 2012. Look at the volume of listings compared to now.
It was massive in 2012, and it was half.
Yeah.
But funnily enough, in that downturn of 2010 to 2012 in Sydney, price falls for the citywide average were only about a 5% decline. This time round, it's been towards 15%. Northern Beaches on the last downturn did correct by about 15 to 20%. And this time round, the correction has actually been certainly less than 10%.
Interesting.
So there's been a change on the Northern Beaches, funnily enough, in this cycle.
There you go. And then finally, the lower North Shore, again, another wealthy affluent area.
Yeah, another wealthy affluent area, which once again hasn't been affected as much by the downturn. But I've got to say, when we look at rental vacancy rates in the lower North Shore, they haven't been too flash hot at all. Yeah. So on the rental market, it's a different kettle of fish altogether. But in terms of the for sale market, it has been more resilient and has been operating a little bit like Sydney's East.
So, Louis, there's often what I call a lag effect between when market signals change, when prices rise or fall, or when interest rates change, but particularly with, I guess, the market sentiment now turning up. How long does this lag effect take to kick in before vendors realise, gosh, it's actually a good time to sell? I'll think about selling up. Is it a 3-month thing, a 1-year thing? How long do you normally see this lag effect really take effect?
It can vary from region to region. I think sellers are overall now starting to come to the marketplace, but we do note that when we look at auction listings in particular, they are down compared to this time last year still, even though they are now picking up ahead of the spring selling season, that they are down year on year. I think what we are going to find over the next 12 months is that auction listings and overall seller activity is going to pick up again. So no one, of course, wants to sell at the bottom of the market. And I think that's been running through sellers' minds in recent months, that if I sell now, I'm selling at the bottom. We're now past the bottom. So I think sellers will take advantage of the higher prices we're now seeing in the marketplace. And as mentioned before, look, we live in uncertain times. I really do not know how long this new recovery is going to last. And the concern I have with it is, as mentioned, we've still got a bit of an overvalued market in Sydney, and we've also got a scenario here where the regulators could just step in any time they want. And indeed, earlier this week, we had APRA come out and put a warning on the Sydney and Melbourne housing market. So they're now starting to make some noises. They didn't say that they're going to respond or they're going to act, but they've said that they're watching the market.
Well, it's not surprising they're closely monitoring that. So let's turn now to auction clearance rates. And we've seen a really rapid bounce back as the market has improved. We're sort of, this time last year, we were in the sort of low 50%, 40, even 45% range for clearance rates. But last weekend in Sydney, we had a 77% clearance rate. And here's the regions, Louis, as to what's happened again. And you can see Inner West there, look, as a star performer, it was 87% clearance rate from 41 auctions. What do we have? The City in the East, 76%, almost 77% clearance rate. Northern Beach is 70%. I think it was almost 80% the week before. And the Lower North Shore, so the Lower Shore 75%. So again, what do those figures tell us in terms of the market activity?
Well, it's no great surprise that we would see a rise in auction clearance rates in the inner ring of Sydney. You generally see that first on a new recovery. Auction clearance rates start to pick up in the inner ring. Traditional auction areas, you start to see more activity. And clearly we are seeing more activity in these particular regions. Yes, the market has certainly turned. Auction clearance rates have picked up. I will say that, look, I think when we take into account unreported results, the clearance rates, the real clearance rates probably a little bit lower than these numbers are presenting. But nevertheless, the point being that clearance rates have picked up. They are at levels which would suggest prices are certainly rising.
And the trend, what do you foresee as we go into spring? Do you foresee a slight reduction in these rates as we get more listings, or pretty much the same level? Where do you see the trend happening here?
Yeah, look, it's a very good point, Rich. You generally find every spring to summer season auction clearance rates fall each year in Sydney and Melbourne, for that matter. The reason being is that there's a seasonal surge in listings that occurs every spring. I'm not too sure why this occurs still. I think it is seller behaviour,
well, it's funny
psychology, where people think now's a good time to sell in spring, the flowers are out. It could also be people want to tie up their affairs before Christmas.
Very much
but
so.
It happens each and every year.
It's a psychological phenomenon. I wrote
Yeah.
about this in my spring update about last week, and I actually talked about the psychological aspects of selling in spring.
Yes.
Yes, the flowers are blooming, the weather is warming. It's not today, it's pouring with rain. But last week, obviously, on the weekend, we had lovely warm weather.
Yeah.
But it is. It's very much getting ready for Christmas, the anticipation. It's the sense of optimism that comes into people's minds.
Now, the only problem with that is that every seller's thinking, or nearly every seller's thinking that. So you have this seasonal surge in listings. And so I guess if I was a seller and I wanted to try and time it on the seasonality, I would actually pick early autumn or indeed winter. And
that's a smart operator saying that. I would do the same.
Yeah.
But not everyone follows the herd.
That's
how do you be
you
a smart investor or a smart buyer? Well, it's not to say you can't get a good buy in the spring season.
Oh, no, there's still plenty of buyers.
And if you have the right property, you can still and get a good result. But it's all about,
it's just your competition. You're competing with a lot of other vendors out there at the same time.
Exactly.
Right. But I've got to say, historically, there's no evidence that the seasonality we see has a real impact upon prices.
That's right.
It's, of course, more cyclical factors that influence prices.
Exactly. Well, Louis, that's enough on auction rates. Let's have a look at days on market. And this is the figures from CoreLogic. And I'll just move our heads out of the way there. But yeah, obviously you can see that the days on market has increased in some areas and reduced in others, mostly increased, I believe. But what are those figures telling you?
It's a similar trend to what we're recording and showing up in those listings charts I showed before. The reason why we're suddenly showing a rise in days on market right now is because a whole bunch of old stock is now selling, and that pushes up the days on market. Correct me if I'm wrong, I think CoreLogic works out their days on market based on what's actually sold.
What's transacted, correct.
Yeah, so there's going to be this skew upwards when you see a big increase in sales activity on stock that's been on the market for like half a year or more.
But what's interesting is during the boom time, I don't know if you remember the numbers, but Sydney got down to about 24, 25 days during the boom. Melbourne, fairly similar, 26, 27
days.
And
they were very, very tight numbers. And it did illustrate the boom for all it was worth.
And we had properties transacting in 4 days at sometimes. An agent would list a property, we're out there, we had to transact within a week. It was absolutely nuts.
And pre-sales activity, pre-listings activity was running hot too.
It's going to be nice to get back to what I call a more balanced market. And I think as we go through spring, as more listings come, I think that will happen. But it's just interesting to note that trend of what you say, the older listings are coming onto the market, which is pushing the averages up. So let's have a look at how that translates, Louis, into asking prices now in the region. So this is the Sydney-wide one, and then we'll drill into the regions. But just a general comment, what's happening with asking prices? Where are they moving at the moment?
Well, the charts illustrate here, we've got the light blue line representing all houses, the darker blue line representing 3-bedroom houses, and then the pink and purple lines representing all units and 2-bedroom units. Maybe I'll just talk about units first to get that out of the way. So far, not much activity at all. It's fair to say that units outperformed the market in Sydney during the downturn. But there hasn't as yet been a real major pickup in activity from what we can see on the unit side. Most of the action of late's been on the houses side. And funnily enough, it was the houses which corrected the most during the downturn. So as mentioned, our series is showing that for all houses, the bottom occurred the week of the election. Now, since then, basically asking prices now risen by some $85,000 from the bottom. And that's translating to a price surge of over 5% since May. So a big leap in asking prices. Certainly that means vendors are becoming more confident about the market. And as mentioned before, they're not really interested in selling at the bottom, so they're adjusting accordingly. And I think that's what is going on. But as we know, given the fact that despite this rise in vendor asking prices, auction clearance rates have picked up, overall sales activity has picked up. So the buyers are at this stage willing to buy at these new prices.
Okay. So let's drill into the regions now. So let's have a look firstly again at the Eastern Suburbs. What's happening with asking prices there? Are they asking too much or too little, or fair value?
Where on our numbers, asking prices have actually hit a new high. Or coming up to a new high. So this feeds into the comment I made earlier that the Eastern Suburbs really didn't have that much of a correction during the downturn. There was a bit of a correction, and it's showing up a little bit more on the unit side as well. But as you can see, if you consider the longer term trend, basically the Eastern Suburbs is still trending upwards at this point in time. And I would suggest that shortly we are going to see further new highs with asking prices in the east.
And I tend to replicate that theory as well. It's a tightly held market. There's a very limited land supply. It's extremely attractive. It's got some of the most prestigious real estate in Australia.
Correct.
So all of those factors, lead to a shortage supply, high demand, and prices are on the rise.
You may note that if we look back at the chart back 2011, 2012, that was when the last time we had a real correction in the east, and the prices did fall by some 20% during that time. I think this goes to show too that in part the east is influenced by what's happening with the local economy. Now you may recall that time, that was from the previous state Labor government, and I don't want to put the boot into that government too much, but it wasn't exactly a great time for the local economy. And I think the east reflected that in terms of the east housing market reflected that.
Definitely, yeah.
And since then, we've definitely had a pick up, and my bet is that the east will still continue to rise for the immediate future.
All right, so let's move again to the inner west. What's happening with asking prices there in the inner west?
Well, going back to my earlier comments, the inner west had a fairly large correction during this most recent downturn. And that's showing up there with the asking prices. One thing you can see fairly clearly now, if you're a chartist, is that you can tell that there appears to be a bottom now with asking prices, and arguably the market's now actually starting to pick up in terms of asking prices. It is also the case to a lesser extent with units there as well.
I really love the inner west. I always think it's got always great potential. There's often a lot of great little terrace homes and duplexes, townhouses that need renovation. It's a renovator's delight in the inner west, but it's also trendy. It's also got great access to the city, great public transport. So no, it's not as fully priced as the east. So I think it's got sort of, in my view, more potential upside.
Yeah, no, fair call. I would only say for the east is that you don't have to worry about the overflights, do you?
No,
in some suburbs you do.
Well, if you're living
in the inner west, you'd need to worry about that.
Marrickville, Leichhardt, the A380.
Yeah, you got to watch out for that, right? So
definitely.
So look, I personally think there'll always be a bit of a premium of the east over the inner west.
Always.
But that premium could narrow up over time. We'll find out.
Yeah. All right, Northern Beaches, Louis, where are we going with asking prices there?
Yeah, well, as mentioned before, we can see that, look, there was a bit of a correction in the most recent downturn, but nowhere near as much as the Sydney-wide average. And our view is, well, it's not really reflecting too much because of the scale on the chart. The 2010 to 2012 downturn was greater for the Northern Beaches than this most recent downturn. And as we can see of late, there's been a little bit more of a pickup in asking prices for houses. Could the Northern Beaches outperform this most recent in this new upturn? Potentially, yes. Given the stock levels that we've just covered before, that's suggesting that yes, maybe it could. So there's a bit of activity occurring on the Northern Beaches. I've spent a bit of time living on the Northern Beaches in my earlier life, loved it, but I've got to say the traffic got to me in the end. So we moved down.
Bring on the tunnel, hey? So
that's right.
6 or 7 years away.
So if that tunnel does proceed,
that'll be a game changer, right?
It could very much be a game changer. Yeah. And of course, there's other road improvements occurring right now in the Northern Beaches, which will help. But I think the tunnel would help a lot. Definitely.
Well, the new Northern Beaches Hospital and the roadworks are driving me spare, but when that's finished, it'll be much better. But let's have a look now, Louis, to finish off the asking prices, lower North Shore. This obviously a little bit volatile.
Yeah, it's a little bit more volatile because it's, in terms of the stock of houses for the region, it's not a huge amount of stock falling, There's a fair degree more of units there, although the ratio of units to houses is actually quite high for the lower North Shore. Nevertheless, when you consider the ups and downs and the ranges which is occurring on this chart there, you can see that really there wasn't a major new bottom formed during this most recent downturn. So our view is that the lower North Shore did actually outperform during the downturn reasonably well on the full sale market. As mentioned on the rental side, the lower North Shore has been recording ever rising rental vacancy rates at this point in time. It's definitely a tenant's market.
Okay, fantastic. All right. Before we go into vacancy rates, I guess just a couple of quick questions, Lou, and I'll just bring our heads up again. So I guess we've talked about those regions, but do you see any significant opportunities in any of these regions for buyers? Is there a particular sort of type of property or market that you think that buyers maybe could target?
Yeah, really good question. As mentioned, we're coming from the perspective that we're a little bit concerned about how and when the regulators may step in again, because we do think the market is a little bit overvalued at this point in time. And so I guess that means some of the opportunities are limited to an extent. Do I think that there are long-term opportunities in areas such as Sydney's East and inner West? Yes, I do. There's opportunities across Sydney when you take a longer-term view. But we are coming from this new upturn with just a little bit of caution placed there, because we do not know how the regulators at this point in time are going to respond. Could they hit the market with another hammer again and restrict lending? Yeah. There is a chance they could do it.
So if you're a traffic controller, I've just got this visual image of you saying the lollipop man said, move forward with caution. Is that the idea?
I guess that is probably the way to look at it at the moment.
Yeah.
The other side to this coin, though, is that if we were to see a scenario where cash rates got to 0% and lending rates overall fell by, say, another full 1%, that would juice up the market. Yeah. There's no question about that. This is a case when you see this on commercial property, the market operates on yields. Yes. Residential less so, it's more of an emotional thing, of course, but nevertheless, the market is responsive to interest rate settings. So if we were to see another rate cut, that could really fire the market up. Yeah. Interesting days.
Well, if you believe one of the best forecasters like Bill Evans, he's predicting one in October and another one next year. So
I've seen Bill's forecast. I think what's riding on the minds of the RBA now, and they've more or less stated so, is that they're watching the housing market. So they do not want to see a new boom.
They don't want to fire it up, do they? No.
Well, the problem with that, Rich, is that the housing market. Let's talk about the national housing market, because yes, we've been talking about Sydney today, but if you were to talk about Brisbane, if we were to talk about Perth, if we were to talk about Adelaide, Hobart, Canberra, these markets are not booming at all. There hasn't been much of a response at all to the recent rate cuts or the fact that the Libs won government. The markets, these markets have just simply not been responding. So it's really hard to talk about a national market, but if you use macro-prudential tools to hit Sydney and Melbourne, you could be hitting these other cities as well. So they're in a bit of a pickle at the moment.
Well, that augurs for that argument about having differential interest rates in different states at some point. But anyway, that's a talk for another day. But I guess another question, Louis, is, and I guess it's probably you can even throw it to me, is, but how should buyers even navigate this rebounding market? Because there's a lot of conflicting signals out there.
Yes.
And it's tough because buyers and sellers have got to make a decision on the market conditions as they are. So I guess any advice you'd have for buyers navigating this sort of market at the moment?
I think if you're in the market, you're looking to buy as a homeowner, you're taking a 10-year view on the market, go for it. It's not, I don't think we're in a boom right now. It's not like as though we're back in the days of 2015, 2016. Mind you, those auction clearance rates, seeing that where they are now, is suggestive that, look, there's a lot of strength there. We'll see how auction clearance rates fall during the later part of this current spring selling season. So the market, in my view, hasn't entirely been fully tested by lots of seller volume.
So the test is coming, is what you're saying.
There's a bit of a test there. I think the market's going to pass the test, so overall, and I think prices are going to keep rising from here. Look, it's a hard one for buyers. Will prices be higher than where they are now in 12 months' time? I think the odds are they will be.
Yeah, okay. I mean, my advice to any buyer at this moment is you've got to do your research. You've got to look at it, as you say, Louis, if you're taking a long-term perspective, which you always should with property, unless you're a trader. If you're a home buyer, make sure you're buying the right kind of property that's going to future-proof your needs in the right area, because it's expensive if you make a mistake. If you're buying $1 million property, there's $42,000 in stamp duty there. If you make a mistake, well, you've got to spend that again to buy the right property. Buyers should be looking at their commute to work, all of their other social activities that they do, and the sort of amenities they want to get, and buying a property in a suburb that's really going to suit their needs. So I think the message is spring is going to bring some more listings. I'm not seeing a flood of listings coming when I'm talking to the agents on the ground. They're saying they are doing more appraisals, but it's patchy. Some areas, agents say, I just can't get any stock, Rich. Other agents say, I've got 10 coming on in October. So I think it might be a bit of a late spring rush that is what I'm anticipating to see coming. So I think any buyer out there shouldn't panic. I think the message is be patient, be selective, certainly get advice and get the right kind of research to help you make those decisions. I guess another question is talking about upsizes, Louis. I mean, there's downsizes and there's upsizes.
Yes.
And we've sort of mentioned the boom and the FOMO thing that came during that boom of fear of missing out.
Yes.
But I guess for upsizes, do you think it's a good time for upsizes to be sort of entering the market at the moment?
I think it was a good time. It was a great time, say, from this time last year through to the election for upsizing. Because from what we can see, the market, particularly between, say, $2 million to $6 million, was correcting more than the market below $2 million, which was in part supported by first home buyer activity. So
but they haven't missed the boat completely, have they? So I mean, I know it was an even better time last year, but would you say it's certainly a time that's coming where they should just stay put, don't upsize? No,
I mean everyone's got to act to their own personal affairs and what they want to try and achieve in life. It's not a bad time to upsize. I just would say it was better.
Well, what do they say? The best time to buy was now. I mean, the best time to buy was last year. The second best time is now.
Yeah, this is true. So, I think when we consider that bracket, the $2 to $6 million mark, the odds are on that we will see a fairly strong recovery in that bracket. Over the next 12 months. So if you're looking at upsizing, I probably would want to do it sooner rather than later. If you're going to do it.
And we help a lot of downsizers too. So we're talking the other side. People sort of at the end of the big family home, moving's a big deal. What's your take on the downsizing market going forward?
Well, the downsizing market could be rather good going forward, because if my view is correct, that we'll see that a $2 to $6 million bracket rise and outperform. The lower end of the market might not perform as well, and therefore there is an opportunity there to downsize and do pretty well out of it.
Okay, fantastic. And Louis, is there any markets or property types people should be avoiding? Like, is there any kind of particular? I mean, we've had the Mascot Towers and the Opal Towers, which is scaring a lot of people with off the plan.
That's right.
But is there any sort of segments of the market or places? I mean, I think we even mentioned on the phone the other day, Box Hill.
Sydney's northwest is an area we're not expecting to perform well at all. It has been hit hard in the downturn, and I think people need to understand why this actually has happened, that Sydney's northwest has been hit harder. That is because there was a whole bunch of new Crown land opened up to the market back in 2013, which was initially released by the state government, who wanted to deal with an issue of a rental crisis at the time. You may recall there was a big shortage of rental properties. So the response was, let's open up Crown land in Sydney's northwest around the Rouse Hill, the Box Hill area, and that happened. The issue was that a lot of land was released all at once, and it's created this flood of stock, which is still with us today, and it's showing up big time in our rental vacancy rates. So in some of these areas, we've been recording rental vacancy rates at 7%, which is pretty high for Sydney. And that's created a bit of a ricochet across the rest of the market. When you have one region recording big rental vacancy rates, it can actually affect the rest of the rental market across Sydney. And sure enough, we've been having that. So that's been an area where, okay, if you're a bargain hunter, potentially you could go in there and go pretty hard if you wanted to, but you'd want to be very careful about it.
Well, that's a great segue to this next slide, which is vacancy rates. So let's have a look. We'll go through the regions again, what's happening across the board, and then we'll dive into the regions.
Yes, well, look, I mean, just talking about that shortage, if we go back to, say, 2010, 2011 and 2012, this was a time when Sydney rental vacancy rates were roughly around 1%, in some months under 1%. It was definitely a landlord's market. And then we spoke about the fact, look, okay, state government did respond, right? They hit the market all at once. Now, 2014 was when they made this announcement, but it wasn't until really 2015 and 2016 that we saw these dwellings being completed and available for rent. And then sure enough, big rises in rental vacancy rates from basically 2017 onwards to the point where we've got a rental vacancy rate of over 3% in Sydney. We think that rental vacancy rates in Sydney are going to peak at 4%. So there's more to come.
More to come.
It's about to hit shortly. So we think that, look, our December read could be at 4%. But that's when the market should finally peak from that point onwards. Okay. But at the moment, it's a tenant's market. It's been reflected in rents. We've been recording falls in rents across Sydney. Some areas, as mentioned, have been hit harder than others.
Well, let's have a look at the individual reasons. So we'll start with the East again. So again, similar pattern there.
Similar pattern, but the East has also been influenced by the big rise in rental vacancy rates. This is definitely a tenant's market right now in Sydney's East. We've got a rental figure there of basically over 3%, and a very similar trend to what we recorded for wider Sydney.
Okay, and the inner West, almost the same number again?
Almost the same trend as well.
Yeah.
The big rises from 2017 to 2019. Now, of course, we are aware that in the inner West, a lot of high density development did occur during this time as well.
How much more of that's to come on, do you think? Like, do you think, I mean, everyone talks about Sydney's oversupply, but it's only in certain pockets, and I believe it's only a temporary oversupply given the volume of people coming in. So do you think it's a 6-month overhang or a 12-month?
We're hitting the peak now in terms of dwelling completions in Sydney. It's taken a while to get to that peak because of all of approvals which were basically signed off on back in 2016, 2017. A lot of that stock which was sold then is coming on the market now.
Yeah.
So in average, it takes between 2 to 3 years between an approval, developer wants to do something, get some pre-sales, and then finally hitting the market.
That's right.
It's now occupied. So there is that lag, and so Sydney's rental market is suffering from that lag effect. And yeah, so the inner West has been affected. All regions to some extent have been affected by it.
Northern Beaches, and we'll just do last Northern Beaches and North Shore. So similar number?
Similar, but less number. So there's been a rise, but we're not hitting the threes, and it's actually recently come off the threes.
Okay.
So that's starting to trend down a little bit now. We'll see. There is seasonality in the Northern Beaches numbers in the sense that we record higher rental vacancy rates during the wintertime and lower vacancy rates during the summertime.
I know that from personal experience in leasing a property in Manly. So don't ever lease it in winter. Always release it in summer. You get a much better price. So.
Correct.
And lower North Shore. We're seeing quite
we're recording higher than average rental vacancy rates in Sydney's lower North Shore. That goes back to some of the comments I made earlier. So it's been a market which has definitely turned into a tenant's market. It will peak. We will start to record falls in rental vacancy rates for the lower North Shore. I think will start happening next year. But for now, tenants should make hay while the sun shines.
Okay. And Louis, just got a couple of questions for you, just about immigration levels. So sort of mentioned about oversupply, but where do you see immigration going, and what sort of impact will that have on the property market?
Well, from an analyst perspective, the immigration data has always been a bit grey. It comes from the Foreign Investment Review Board. They do updates really only once a year. It's not precise. So it's really hard from an analyst perspective to really understand what is actually happening. We do know through the overall population numbers for Sydney that the annual population growth rate has actually come off a little bit from its peak. So if I recall, the peak was about 1.7% per annum, and that's sort of come down a bit to about 1.5, if I recall the number. So it's slowed a little bit, but still that's a strong result at 1.5%. But yeah, that's had ramifications in terms of that surplus stock we've just spoken of. That, okay, well, we're still running at the height of population growth, the growth rate was, then that stock would have been absorbed sooner than what we have now.
Yes, right.
The stock will, though, get absorbed. I mean, at 1.5%, we are talking about, the city expanding by about 100,000 people each and every year. It's a lot of people.
It is. Yeah, it is. It's a lot of people. Yeah.
So, and you can generally run it on the number of people per dwelling, roughly at about 2 people per dwelling. You can run it at just a bit over 2 people per dwelling. So we think that there's surplus stock there out there in the Sydney marketplace of over 60,000.
Because my understanding is that the government's capped immigration about 160,000 per annum nationally.
Yes.
It was at about, I remember one year it got up to 230 or 240,000 migrants.
Right.
But we have a skilled migration program. We're bringing in well qualified and generally even some SIV and PIV, so significant investor and premium investor visas as well, but that's by invitation. So I don't know the exact numbers on them, but they are coming. We've helped a couple of them to find properties in Australia. But it's interesting. I think the immigration levels definitely has a dramatic impact on the market, depending on whether they turn the tap on or off.
Well, let's consider that most immigration goes to Sydney and Melbourne to begin with. So it can have an impact upon our two largest cities.
That's right, yeah. So Louis, we've sort of touched on interest rates, but I guess the bigger question is the risk to the economy and the overall impact. So do you see if there's any kind of systemic risk or any significant risk coming with our economy? Some people talk of recession coming and there's doom merchants, others are more upbeat, but what do you see as sort of the general pattern for the next couple of years with the economy and the risk that could have on the property market?
The largest risk to the economy is a global risk, a global trade war, which we're seeing kind of being playing out now between China and the US. That could be a big negative for the economy if it did turn into a global trade war. You would likely see a recession. That said, though, our regulators have the power to respond. And I think this is one of the things that the housing bears have got wrong for a long time now, is that they have underestimated the ability for the powers that be to respond, whether it be by interest rate cuts, whether it be by fiscal stimulus, whether it be by a first home owners grant scheme. Never underestimate the ability for our leaders to respond to the housing market. Now, Rich, I've got to say, I'm not overly happy long term. I think it's actually unhealthy that you have the economy and the housing market tied to the hip with each other. I think I would like to personally see a little bit more separation from that, because it does create lots of risks on both sides. And it makes it hard for the authorities to respond with monetary policy. They want to try and get the economy going, but they know that means it's going to be a boom for the housing market. But we're not going to be able to resolve that anytime soon. So for now, the two are going to be tied to each other. And I do believe that if there was a real danger that came along, the authorities would act, and they still have the ammunition to act.
And I guess we've touched on lending standards, but just sort of to round out the discussion on lending standards, APRA put the squeeze on the banks several years ago. I think it was 2014 they brought in the changes.
They started from 2014. They started turning the screws from that year on.
The year. And we've just seen this year relaxation on one of the serviceability requirements. That's right. And that's now starting to translate into potentially almost a 6% increase in borrowers' capacity, depending on their income levels. You've mentioned that APRA could move again. Do you think that's likely or just a possibility?
Well, I think the probabilities have increased after some of the comments that came from the APRA chairman this week, where he basically warned about the Sydney and Melbourne housing market entering into a new boom. So we don't know where and we don't know when, but they could respond, and I think they would respond if Sydney and Melbourne did go into a new boom where we will see double-digit annual price increases.
So watch this space is what you're saying, and watch the trend.
Yeah, I think they would respond. And potentially what may well happen, in an ideal world, you would see, if you had a slowing economy but you don't want a new boom in the housing market, you would see APRA react, but at the same time the RBA cutting rates. But I won't want to put bets on that happening. It will take a lot of coordination.
Sure, okay. And looking ahead at pricing, both in Sydney and Melbourne, at what point do you think Sydney and Melbourne will surpass the 2017 peak? Do you think that's sort of within a year, or do you think that's a bit further away?
Well, for Sydney, it's about another $100,000 to go, even taking into account the most recent price gains. Could it happen in the next 12 months? If we had a boom, it would happen. I know some agents have been saying, we're getting 2017 prices now. All right, maybe in pockets you might be seeing some of that, but the overall Sydney aggregate's still not showing that. Look, it just depends how rapid this new recovery turns out to be. So it is possible it could happen in 12 months. If it does, mark my words, the regulators will step in.
Okay. And Louis, you've been remarkably accurate with your housing boom and bust reports at predicting where the market's going. I've got to say, of all the commentators, I respect your research the most. Because
thank you.
No, not sort of buddy you up, but just seriously, you've been very accurate, and I really enjoy reading your reports. What's your secret? How do you, as an analyst, how do you kind of work out how to predict it? What's your kind of, you don't have to tell your secret, but
I've got to say it's become more challenging.
Yeah.
Before we had APRA operating in the market, it was about interest rates in many ways and what the overall economy was doing. It's a combination of considering fundamental factors, overvalued, undervalued, the leading indicators as well. And as you know, we've been at the forefront in terms of developing the leading indicators on the market. And that certainly helped. Getting a good take in terms of what's happening on the auction market always helps, but it's never perfect. Back in late 2017, we thought there was a slowdown, but we didn't think prices would fall as much as they would, in part because the housing finance approvals and the auction market was only suggesting a slowdown at the time. If I left my report another 6 weeks, I probably would have had a different view.
Okay.
So timing is everything.
Time is
and
everything.
We certainly don't always get it right, but we've been good enough to have pick some of the major points.
But you can do a revised forecast. I mean, like any economist, you've got a revised. You take the most available data.
No one likes to do that. No one likes to do revisions. But in this industry, I think what's important is that you're always upfront and open and transparent with everyone.
Yeah. But you do it really well. In your reports, you go, the base case is this: if interest rates drop 0.5%, if they drop 1%,
that's it.
I mean, it's all about.
And so this is what we do. And so we model that in. So I've got a modelling system which does take into account some of these macro variables. And so, yes, I can't say I'm a great predictor of what interest rates are going to do, but if interest rates do X, this is what will likely happen in the marketplace. But as mentioned, my job being as part of being a forecaster, is becoming more and more trickier because, in my view, fewer and fewer people are having more influence upon the marketplace. If you think the chairman of APRA, he's got a lot of sway on the market now.
Exactly, he does.
So there
more than people haven't heard of APRA until they brought those changes in. People are now understanding what's this organisation, what do they do. Absolutely having impact.
That's right. Yeah. So, and for me as an analyst, and I'm trying to work out, well, what are these people actually thinking right now? And that can be very challenging.
That's challenging. So, Louis, if people buyers and sellers out there want to get information that you can provide, where do they go? To your website?
Sure. Yeah. I mean, we talk about forecasting. We've got a lot of data on our website, sqmresearch.com.au, and you'll find we run postcode snapshots. We have a distressed properties report. We've got all the free charts which we've gone through today, right down to the postcode level. So, it's all there.
Brilliant. That's great. And look, just to finish off a couple of things, we can just go to presentation mode again. We'll find it. Just in terms of my company, propertybuyer.com.au, we help buyers in this market particularly go through this 7-step process to find their ideal property. We can also help vendors with what's called a vendor advocacy service. We don't sell properties, but we recommend them to a local agent. But we provide independent advice and help them at each stage of the journey, Louis, on their step to buy a property. So again, using some of your research, and we shortlist properties, we negotiate, provide all that due diligence. So it takes all the sting out of the pain of buying a property. And the average time, most people actually spend more time planning their holidays than they do actually buying a property. So we like to outsource that function and to ourselves and help them on their journey. And we've won over 33 awards for excellence in our time as being a buyer's agent. So we certainly know a thing or two. So I'd just like to say thank you very much for watching the webinar this evening. Thank you, Louis, for your excellent contributions.
Thank you for setting it up.
No, I appreciate it. And we certainly look forward to being in touch with you. If you'd like to get in touch with myself, my details are there on the screen. And we look forward to speaking with you again very soon. Thank you very much.